All right, let's get into a topic that's pretty much everywhere right now in tech and finance. This idea of an AI stock market bubble. We're going to break down what that even means, how it works, and most importantly, why it could matter to you. Okay, so let's just dive right in with the big question. We all hear about how AI is going to change the world, right? But what if that incredible promise also carries a massive risk? What if all the excitement is actually creating a financial time bomb? That's what we're here to figure out. So before we can debate whether we're in a bubble, we all need to be on the same page. What exactly is an AI bubble anyway? At its core, a bubble is really just this huge gap between hype and reality. Think of it like this. Investors get so unbelievably excited about what AI could do in the future that they drive stock prices to these astronomical levels that have absolutely no connection to how much money those companies are actually making today. It's all based on a dream of tomorrow. Now, something like this doesn't just happen on its own. It's not one person's fault. It actually takes a whole ecosystem of different people and companies, all kind of chasing their own goals to pump air into the bubble. So let's meet the key players. And here's the crazy part. When you look at this list, nobody is really doing anything wrong, are they? I mean, their goals make perfect sense. Investors want to make money. Tech companies need funding to grow. But when you put all of these perfectly logical actions together, you create this powerful self-feeding cycle where everyone's personal interests just happen to align to push those prices higher and higher and higher. Okay, so how do all these separate actions come together to create this massive upward spiral? Let's walk through the mechanics of how this thing actually inflates, step by step. It always starts with a spark of something real. A tech company launches a genuinely cool new AI product, and people get excited. And why not? It's impressive, so the stock price starts to climb, just like it should. But then, the hype machine kicks into high gear. Investors see this new tech and they start dreaming big. They're thinking, this is going to change everything. They get a serious case of FOMO, the fear of missing out, and they all rush in to buy shares, which sends the price soaring way past its initial value. Pretty soon, all logic just goes out the window. It's not about company performance anymore. It's a full-blown buying frenzy. The price is now being driven purely by emotion and the collective belief that it can only go up. And this is where you can really see the cycle in action. The hype creates a high stock price. The company then brilliantly uses that inflated stock to borrow billions of dollars. And what do they do with that money? They spend it on a mountain of computer chips and new data centers. And to the outside world, that looks like incredible growth, which, you guessed it, creates even more hype. It just keeps feeding itself. But here's the thing about a machine that runs on hype. Eventually, it runs out of fuel. Reality has to set in at some point. So let's look at that tipping point, the chain of events that causes the whole thing to come crashing down. See, reality always wins. And it's not usually just one big thing. It's a series of dominoes falling. It starts with the actual customers, the businesses who are supposed to be buying all this AI. They look at their budgets and go, you know what? This isn't really making us more money yet, so they stop buying. Then the lenders get nervous and turn off the fire hose of cheap cash. And finally, the tech company has to release its earnings report, which shows a ton of spending, but not enough money coming in. For investors, that's the final alarm bell. And just like that, confidence is shattered. The mad rush to buy turns into an absolute panic to sell. Everyone tries to get out the door at the same time, and the stock price just collapses, wiping out months or even years of gains in a matter of days. Okay, so a bunch of numbers on a screen go down. Big deal, right? Well, the fallout from a popped bubble goes way beyond Wall Street. This is where it starts to affect real people in the real world. The first hit is just the staggering amount of money that disappears. We're talking billions, sometimes trillions of dollars in value that just vanishes into thin air. But that's just the first ripple in the pond. And this is where it gets personal. That investor wealth that gets wiped out, a lot of that is in your retirement account. To survive the crash, tech companies lay off thousands of people. Other businesses get spooked and stop spending, which can drag the whole economy down. All of a sudden, it gets harder and more expensive for everyone to get a loan for a car or a house. And ironically, the very AI innovation that started this whole thing, it grinds to a halt because all the funding just dried up. This line from the analysis we've been looking at really just says it all. The key word here isn't drop, it's destroys. This isn't a gentle correction. It's a destructive event that sends shockwaves through the entire economy, affecting people who never even bought a single share of stock. Which brings us to our final and maybe most important question. Look, the AI revolution is real, it's happening. But as we've just seen, the financial excitement around it can get way ahead of itself. So the big challenge for all of us, as investors, as employees, as just people living in this world, is to figure out where the real, solid progress ends and where the risky, dangerous hype begins.